Okay. So let's go through, well, any questions on any of the exercises in Chapter 8 about capital gains? Like I said, a lot of the stuff we'll come back to because of its pertinence with the selling business assets and stuff. I like to show it when it's in action with especially real estate, when you depreciate something and you got to sell a investment property.
I was reading it. I mean, you could say you're carrying forward capital losses.
Yes.
And you get a capital gain on a property, and I assume your depreciation recapture gets added to that capital gain as well.
Yes.
Okay. Now let's assume you can technically take that against your capital losses, but what the bottom line is, if your income is not high enough to pay capital tax, right? There's certain limitations on income.
Yes.
It seems like a wash or a waste of capital
Losses carry forward. Yeah, there's some restrictions because you look at parts of the way that the Schedule D works, where it's calculating in there the limitations on what you can use and what you can take based on what else is on there. And that's where, like I said, when I have clients that are sitting there carrying forward these huge amounts of losses, they're just, the possibility of eating them up before they die is almost impossible. And, everybody asks the same thing, can I just get a check from the IRS? It'd be nice if somebody just turned around and write you a nice 6-figure check on this, but that typically doesn't happen. All right, so let's go through the quiz on page 843. And then we'll get into what everybody wants to do very soon, retire. Okay? All right. Patrick, you want to do number 1 for us?
Name 3 ways to determine the basis of property. Well, cost basis is what you pay for it, adjusted basis, and the basis other than cost.
Yep, and when we do a basis other than cost, what's that term that always came into play? We kept seeing in there, FMV. Fair market value. Okay, that determination of how we do that. I think yes.
With property, you don't include the land in the fair market value, or you do? Well, only depreciation you don't include.
You can't depreciate land. So.
But your capital cost includes the land.
Yes. Give 5 examples. Oops, I'm sorry. Number 2, Mark.
Yeah, give 5 examples of capital assets: stocks, bonds, commodity, real estate, even a personal automobile. A lot of things could be capital assets.
Yep. Stamp, coin collection, jewelry, home. There's several. So, it's just asking for 5. So, all right. David, number 3.
Form that appropriate uses to report the sale of stock is Form 1099-B.
Yep. And remember, we see that 1099-B that's in our problems and stuff. That's that nice little looking like a W-2 or interest 1099s, normal 1099s. But most of the time, that handout that I gave you is the way you're going to see those. And they're nice because they have a little header on them that says, hey, this is goes to Form 8949 with Box A. But just remember, nothing goes on the D. Nothing goes on the 8949. Use that capital gains worksheet, because then it just goes.
And then it moves it right over.
Yeah, and then you can go check and know that it was in the right spot and everything like that. So
we used to call that a form of 1099 composite
when
I worked at Schwab, and it's a lot like Majestic Fidelity, just saying.
Yep.
Everything all together.
And like I said, you get that one that's 40 pages long. You can use that 8453, where you just kind of recapping. It keeps you from sitting and having somebody watch you type and type and type and type and type.
But 8453 is actually a form, it's not a worksheet.
The Form 8453 is something that would go in electronically to say more to follow. And then that's where, like I said, if somebody's got one of these for 1099-B, that we copy it, send it on a separate count. So, okay. All right. Patrick, number 4.
What 2 things must be true for a non-business bad debt to be deducted? I said must have a basis in the debt, and the debt must be totally worth.
Exactly. Okay. I'll do go ahead, Mark, number 5.
Sure. What are the 2 tests that must be met in order for a taxpayer to exclude a gain on the sale of his home? Ownership and residency.
Okay. All right. I'll do number 6. The maximum amount of money that may be excluded if these two tests are met is 250,000 single, 500,000 filing joint. Okay, all right. And again, Western New York, you're probably pretty hard pressed to find homes that you're going to sell as a couple and gain $500,000 on. Okay,
Now they can exclude potentially up to 2 years.
potentially, yeah, yeah, because you were asking about the lifetime.
And I did look into it. It was the tax relief act of '97
Mm-hmm.
that they made the change.
Yeah, I knew it'd been in effect for quite a while.
Yeah.
But so 97 sounds like a long time ago, but it doesn't really, doesn't it? So, all right, Patrick, number 7.
Tax on gain, the sale of main home that cannot be excluded should be reported on the form 8949, sales and other disposition of capital. Schedule D on form 24.
Yep. So, and you know, that capital gains worksheet, description, sale of home or address or whatever, and you do all the things that you need to do. Obviously, that's what goes in. Behind the scenes, that's why I said I love to see closing statements from both when the house was bought and when it was sold, because that has so much information for me on there. So I can make sure and have that in their file, should there be a question as to how we determine their basis and the gain and stuff like that. So, all right. Number 8, Mark.
The taxpayer has a taxable gain on depreciable property or property used for business. Gain must be reported on form 4797.
That's correct. Okay. All right. And like I said, we'll be back to that because I want you to see it in action with the depreciation. It makes more sense. Okay. Number 9 is, what is the difference between a short-term gain or loss and a long-term gain or loss? Okay. Holding period, obviously short-term gain, less than a year, long-term a year or more, and then they're taxed differently. Okay. All right. Number 10, Patrick.
Taxpayers level maximum capital loss per year is 3,000.
Yes. Okay. Doesn't hardly seem fair, but
Let me ask you this. Let's say you are carrying a capital loss. That's nothing to do with passive income. Let's say you have passive income of 70,000. And the only income you have is passive income. You can deduct all the income again, all the passive income against your carry forward losses or not.
there's a lot of things that are in play there.
That's why you're better off becoming a real estate professional.
I know.
Yeah.
I know the general one is when you're comparing the income, your gains and your losses, you just can't take more than 3,000 losses in a year.
Yeah.
And that amount's been the same for such a long time.
I'm not against W2.
It's always, I can't remember it being different than 3,000.
I don't know. I'd have to look that one up. I don't know how long that. Yeah, you'd seem like that should be something.
You'd think they would maybe move it up.
And you think they might have done something after 2008 to let some people capture, but you know, the number of people that are carrying huge capital losses after 2008 is just boggling, you know, because of what the market did. So, all right, I'll read through the number 11, the maximum capital gain rates. Collectibles gain 28%. Small business stock minus section 1250 gain 28%. Unrecaptured section 1250 gain 25%. Other gain regular tax rate would be 39.6% minus 20, or 20% I should say. Other gain and regular tax rate would be 25, 28, 33, 35. That's a 15%. And other gain regular tax rate would be 10 or 15% would be 0. Okay. So, you know, basically what that's saying is, you know, depending what tax bracket you fall into will determine that, you know, the capital gains that are in there. You know, if you're in that 25, 28, 33, or 35, you're looking at a capital gains of 15%. Okay. And that's where most people that have capital gains are fall.
So it's nothing like in Canada where you take the capital gain, say it's 100,000, you divide it by 2, so you take 50%, so that's 50,000, and then 50,000 is only taxed at 50%. That's how they do it in Canada. So it's nothing like that here. You just get hit with the whole.
Depending where your tax bracket is, depends how much capital gain you're going to get hit with. Yeah. So, and you hear them talk quite a bit. I mean, I don't know what's going to come out of the new tax bill as far as the capital gains, if there's something that'll be give and take, you know, because again, capital gains, you know, what tax brackets do you think most common of? You know, 25% right now. So,
25%.
yeah. So, you know, if they're breaking anything on that. All right. And the last one, number 12, for how many years may capital losses be carried forward?
So definitely
There's no limitation. Yep. And you cannot will them, contrary to my one client's wishes.
Until death. You use car.
Basically, yes. So, but like I said, my one client would love to his grandkids to break up his capital losses and just give it to them to put on their taxes and start using, but can't do that.
You can't do that though.
He'd like to. I said, can't do that.
Can you say you have these losses, can you carry them, say you form an LLC in a partnership, can you carry those losses against the K-1s?
Into the partnership returns?
Not into the partnership. Say I have losses of 100,000. You and I form a S corp or an LLC, and we do some property and there's some capital gains involved, and I get a K-1.
And it comes over to your tax return?
Because it flows to the personal return.
Yeah.
Right. So your K-1 drops down. I make $2,000 or $3,000 in capital gains, which is actually income. It's less than 1 year. That goes right up against my losses.
Because it flow over, because K1 would come over your personal return if that's where your
So in
losses
other
are.
words, if you and I went into a property, and you said you had 10%, I had 80, 90%. 90% of the K1 came down, I get to deduct all the losses. So it work too, right? Based on the percentage of investment.
So you have income coming over to your personal return from,
From a K1.
Yeah.
Say we did a flip.
well,
You're in for 10%, I was in for 90%.
Yep.
Your K1 will show 10% of profit. My K1 will show 90% of profit.
yeah, because that'll flow over as income on your
That's
personal
income,
return.
so it comes right up against my capital, my carry forward. Perfect.
So, all right. Did you get it resolved?
No, their system's still not working.
The IRS? Did you get somebody that at least knew what they were talking about? I hope.
Not sure. There's one aspect to my application, which is responsible party, that it doesn't allow you to input. And I just have to wait until they fix it. But I can do my fingerprints until that happens. He gave me the instructions to complete fingerprints and send them.
Our government's wonderful to deal with.
So I spend all that money for them.
You got to pay taxes for it. All right, chapter 9. We're getting into retirement plans, pensions, and Social Security. Okay? Right where everybody wants to be, correct? All right. This is going to deal with the distribution of retirement funds. Retirement funds come from a variety of sources: employer, government-sponsored pensions, annuities, retirement plans like 401ks, 403bs, 457, profit sharing, IRAs, traditional, Roth, simple, SEPs, railroad, and of course, our government's Social Security, okay? Which all of us in this room, I hope, have a portion of, but I think we will. All right. Again, we get into that term and we'll elaborate a little bit more, but we start talking about qualified versus non-qualified. So, again, we know that there's got to be something that there's probably a test or criteria when we hear that term qualified. All right. We're going to determine the taxability of pension, annuity, IRA, and other retirement plan payments. We're going to determine the taxable and non-taxable portion of Social Security and railroad benefits. We're going to talk about the taxable portions of IRA distributions. Okay. All right. Let's see. Whoop. Hello? Yes. Yes. Sure. Let me look at my calendar when I get back. I'm teaching class right now, and I'll take a look and when I get back and give you a call. Okay? All right. Bye. It must be going to have a baby. All right. We're going to talk about rollovers and the where to enter taxable, non-taxable retirement benefits on the 1040. All right. Retirement plans. Everybody got one? besides Social Security? Okay. Retirement plans are, generally there's two terms, understanding qualified and non-qualified. The term qualified is used to describe both retirement plans and other investments. From a non-technical standpoint, a qualified plan investment is one funded with pre-tax dollars, okay? So we've been seeing on our W-2s that we've been doing in the problems, we got that little D code, and what does it do? It adjusts the taxable in box 1. That's why you have to sometimes be careful. Some people will say, well, can't you just do my tax return with my last pay stub? Well, you got to make sure that that pay stub has information on there, because if their taxable is less some retirement, then that may be the case in there. Okay. Qualified plans are also tax deferred. That means that the taxes aren't due until the funds are distributed. Okay. Basically what it's saying is pre-tax dollars result in a larger pool of funds to grow tax deferred. Okay. Just remember, on the other end, you will pay tax on it unless it's a Roth, because those are tax dollars going in. Okay. The government is going to get its tax no matter what. All right. RMDs, the wonderful things. They basically say that once you've reached 70 and a half, unless what? Anybody know there's an exception to the 70 and a half?
With Roth IRAs, it's not subject to it. Qualified retirement plans, if you're still working.
There you go. Yeah, if you're still working, that 70 and a half is a different thing. So, okay.
Well, wait a minute. So in other words, if you have a plan and you reach 70 and a half, and you're actually still working, you don't have to do the RMD?
Correct. That's right. For qualified plans.
Yep, qualified plans. So that's where some people, what they'll do is with the RMD, while they're still working, they will take some distributions, but to help their tax situation, they'll just do a trustee to trustee where it goes right to a charitable, say the church or something like that. And you can do that when regular RMDs too, because some people, don't want to take the money, but when they're required to, they don't want it to show up as taxable income because of the way it may work with their other parts. And if they're not in need of the money, but they have to take it, rather than take it, put it in their pocket, and then try to do something with itemized, they can do that RMD trustee to trustee for a charitable. So
But the bottom line is, if you keep working after the age of 70 and a half, you don't have to do the RMD.
exactly.
However, what's considered working?
Full time.
Full time.
You got to be employed.
The Obama 20 hours a week full time, or
Now you're mixing the Affordable Care Act with retirement. So, all right. The other thing that comes into play is under 59 and a half. Okay. If you are under 59 and a half, they discourage you by 10% penalty. Okay. That's where a lot of times when somebody tries to take money out of their qualified retirement plan, the brokerage house or fund or whatever, automatic 20%, tax withholding. Yeah. So the other thing that remember too is that with the under 59 and a half, most places will not take state. Okay. So if somebody's going to take a rather large distribution under 59 and a half, you're going to want to talk to them about paying state estimated, because these funds do not want to deal with 50 entities doing state withholding. They'll do the federal 20% mandatory, but they want nothing to do with the states. And even if they don't care if you live in a state where there's no tax or there's tax or high tax, whatever, they just don't. So people have to be very careful. Okay. And we'll talk about the exclusion too with the state of New York for people over 59 and a half. Okay. Let's see here. One exception is an employee-sponsored Roth IRA, which is a qualified plan yet funded with after-tax dollars. It is also tax deferred, yet there's no tax due when the funds are withdrawn after 59 and a half. Okay. There's also, I think Mark brought this up, didn't you? There's also no RMD requirement because there's no tax due on qualified Roth IRA distributions. Okay. I think that's what you were talking about, like with so. All right. Term non-qualified is also used to describe both retirement plans and other investments. That means the investment dollars have already been taxed. Self-funded annuities fit into this category. Non-qualified plans are also tax advantaged because they are tax deferred. Distributions from non-qualified plans are often partially taxable. What's that mean? I know what partially taxable means.
If that's state taxes on the earnings.
Yes.
Not the,
Yeah.
your basis.
Yeah, so if the money you put in has already been taxed as income to you, you're only paying on the growth of the earnings on it. So, okay. All right. Our lifeline for everything that we are going to get for retirement plans are 1099-Rs. Okay. And you just hope and pray that it's coded correctly. All right. Because you do have people come in and they said, well, no, that's not right. And it says, well, it says 1 in the code. So you took it under 59.5 and you have to pay the penalty. No, I took it, one reason or another. Well, we can't change the code. If the distribution from that qualified account shows a code 1 on the 1099-R, that's what we go with. Okay.
We can do a 5329.
Yes. Yes. And we'll get into those.
We'll get into
Okay.
that.
Yep. I try on those. I try all the time on those. I read them, all of them, and say, does any of these apply? And if they say no, I'm like, I don't know what to tell you. Okay. Pensions. Pension generally works a series of determinable payments that begin at retirement from work. A qualified pension plan can be either a defined benefit plan or a defined contribution plan. Okay. Pensions, boy, those just don't exist much anymore. And I feel bad for the Teamsters right now. I had another guy yesterday. Their pension, because the government did not want to give them money to try to bolster their fund, the Teamsters, with investments. Everybody's pension in the Teamsters got cut 30%. So, and this was the first month they were going to get their shrunk check.
I have a pension, I just can't take it.
So, all right. So that's where we have pensions. Annuities, including 401(b) tax sheltered annuity plans. Annuity is a series of payments under a contract made at regular intervals over a period of time more than 1 full year. Where do you see a lot of annuities right now? I know.
With insurance.
Yeah, with insurance policies. Yeah, when you get whole and universal, they tend to have more annuities in there. Okay. And then we have IRAs. A traditional IRA is a tax-deferred plan where contributions are generally deductible. We'll talk about that with adjustments to income, as it says in Chapter 10. A Roth IRA is a tax-deferred plan where contributions are made with after-tax dollars. Contributions are not deductible. It becomes a tax-free plan once the plan holder reaches 59 and a half years of age. Okay. All right. So there'll be a bunch of different plans. Like it says here, we talked, we'll hit later with the IRAs, what you can do with that. Okay. When we do adjustments to income, because a lot of times you'll hear Esther on the radio as, things when people look like they're going to have a tax plan, or I will do it with people with their health insurance. Because if I can figure out a way for them to put money in their pocket and lower their premium through the marketplace, that means the money's still theirs. It's not all going out the door to the insurance company, never to be seen again. So we're able to make adjustments on their health insurance premiums through the marketplace using that adjustment with their contributions, because it's tax deferred then. So, okay. All right. Let's see here. Talk about those when we get into the plan in here. Okay. All right, so we're going to skip the part that talks about the general rule and the simplified rule. I'll show you that. It's a little easier than reading about it to see it in action. And when I do some things, I'll get into TaxWise, and you can see the little worksheet at the bottom that works for that, okay? There is a little worksheet there that shows you the actual IRS one for the worksheet for Bill Smith. Basically, that's if the taxable amount is undetermined, and we'll see that on a 1099-R. And then we can use a simplified method to try to determine. And a lot of times when you do it that way, it's such that their actual taxable portion is less than what the distribution would be, okay? All right, 911. Let's see here. We have rollover options, okay? Make sure we always understand these because we have to have that for determining the tax liability. Direct rollover, that's where obviously trustee to trustee, okay? You basically, your hands never touch it. All right, so we have it where it's going directly from one to another. Anybody know how the 60-day rollover works?
So basically, I can request a check from where I have my IRA account.
Mm-hmm.
And within 60 days from receipt, I could put it into another IRA, for example,
Mm-hmm.
or even into potentially my employer's retirement plan if they'll take it.
Mhm.
That's considered an indirect rollover, 60-day rollover.
Yeah,
But the
exactly.
check shouldn't go to you, it should go directly to the plan. correct? That's a direct.
That's a direct. That's a trustee to trustee.
When it comes to you, it's a 60-day rule.
And in the 60-day rollover, you're gonna have
You have to
you're gonna get a
60
1099-R. Initially, it won't have the code for direct rollover.
Yes.
Then later, you'll get a Form 5498 that shows you did the rollover.
The best thing to do with those is, once you get the check, walk into a bank, open up an IRA, because then the clock stops and you can make the decision on where you want to go.
Yeah. And that's where a lot of times I'll have somebody, just what you talked about, somebody left a job and, whatever the circumstances of them leaving that position, and there's been this money in this retirement plan for them, and all of a sudden they get a check in the mail because part of their separation or whatever, their severance or whatever you want to call it, was that they closed their retirement plan. Well, they get the check, oh, okay, stick it in the bank. Well, come tax time, when I have to explain to them that that was taxable income, I try to explain to my clients, hey, if they've told me that they're going to switch jobs, I'm like, okay, it's a retirement plan. What are you going to do with it? Just remember that if that check comes to you, what do you have?
60 days.
Or you do what David said, walk in there and find someplace, walk in the bank and get in there.
You have to be careful with those funds because, one, you want to make sure that it's coded as a rollover and not a traditional IRA, because then you have the ability to roll it into, like you said, another 401k plan.
Can you roll it into a Roth?
To do that.
If it's coming pre-tax to after tax, that rollover will be taxable.
Yeah, then you got to pay tax on it on the way in.
Taxes on the money.
Yep.
That's just it.
All right, and then there's a little paragraph down there at the very bottom of 912 that talks about, some of the things that go on with survivors and beneficiaries. We're not going to really get into a lot of that. That gets pretty involved with the distributions on those, okay? All right. Unless you're sitting and doing IRAs all the time, you got to go read those as far as what all the rules are for beneficiaries, because they tend to.
I think one of the biggest mistakes people make in that area is when they inherit an IRA and they don't need the money, they distribute it out. They kill their taxes in that area. And there are ways to do it over the life expectancy of the person that's deceased. And you just need to talk to
So
somebody.
then you're subject to a minimal distribution on the inherited IRA.
Correct.
Yep.
This way you can.
And you only pay taxes on whatever is distributed, and you can always cash it in and pay the taxes in some future year that might be
Still have that flexibility.
Yep.
You can take more.
Yeah, because if you break it up in little bites, then the tax liability, because when you start adding it, like you said, you take this huge distribution, all of a sudden they're in the 15% bracket and they send all of this extra income on the return in the 25% bracket. And that's silly.
And all of a sudden they're paying AMT.
Exactly. Exactly.
Or
Yep. So, all right. Then on page 914, it starts talking about Roths. Contributions are not deductible on the return. Again, we'll talk about that when we get into the adjustments to income. We'll see that more so in play there. Because Roths are tax deferred and qualified distributions are non-taxable, there's no requirement to make distributions, to take distributions, including RMDs. Okay. Qualified distribution is any payment or distribution from a Roth IRA that meets the following requirements. It is made after the 5-year holding period, beginning with the first taxable year for which a contribution was made to a Roth IRA. Sometimes people get in trouble with that too, because they forget that 5-year holding, okay? The payment or distribution made in or after the date of the taxpayer reaches 59.5, made because the taxpayer is disabled, made to a beneficiary or to the estate after the taxpayer's death, are one that meets requirements listed under the first home exception. And where do we find that, Mark? You brought that up. What form?
Oh, the 53, I'm sorry.
5329, yeah, what you brought up earlier, okay?
Is it 5329?
That's kind of the get out of jail free for retirement plans.
You know how there's penalty exceptions?
Yeah.
That's the form you fill out to claim your penalty exception.
And we'll see that in there too. Okay, and then it goes through all the things that when the 10% penalty is applied. All right. 915 shows our difference between a Roth IRA and a designated Roth account. All right.
You
Okay.
can always take out your contributions though, right? You don't have to worry about the 5-year
That's
window
correct.
for that.
Yeah, your money. Yes.
Yeah, the part that you put in, you can put it in today and take it out for another time on your phone.
You just can't take the growth out.
That's right. Growth has got the.
So in other words, if you put in 10 grand over 5 years, and you made 10 grand, you took out 10 grand, that's not taxable.
Right.
That's
Only
right.
leave the other 10 in there.
Each Roth conversion.
Sounds like money laundering, doesn't it?
Roth conversion is
Perfect, yeah.
so
I come up with a lot of good ideas.
I see you back there. You got a little notepad going.
Oh, yeah.
So. All right, but a designated Roth account would be much more of a what? Kind of says there the participation. Anyone with earned income is a Roth IRA. The designated is participant in a 401k, 403b, 457 government plan that allows designated Roth contributions. What big thing, and the third one there, is the big difference? Contribution limits.
You mean 457 or the,
Well, just the designated Roth versus the Roth IRA.
oh, it's much higher.
So, you can see that, yeah, because that contribution limits that we're talking about there, those are the ones that we report in adjustments to income, not necessarily helping us. But when you're looking at an employee plan, you can look and see that you could do up to 18,000.
Right, but you have to do it based on earnings, and there are caps on plans too, beyond the 18,000, the way the plan was set up, so it depends on the plan, that's a general.
But it also said that you can put in 18,000 in the 401k, and if you have a qualified 457, that's another 18,000, correct? Assuming your income meets.
No, only per year.
Per year.
Per year.
Yeah.
One or the other.
Yeah.
Per year?
The total is 18,000 contributions, personal contributions. The total for the total amount that can be put in by employer and other contributions, I think it's like 40.
Yeah.
45.
Because that way, the 18,000, if you're trying to max out to get the maximum matching, that's what you're trying to do. The other thing too that I just want to point out here is down there where it talks about loans. Everybody knows how loans against IRAs work. So you take out that loan against an IRA. If somebody tells me they're doing that, I said, is the repayment going to be payroll deduction? Because it has to be. I mean, don't do it any other way.
Like the loan against 401k.
Yeah, because if you do it where you're responsible to make that repayment and you miss one, what happens?
It's all tax.
Yeah.
So if you read the things on this new plan, or I don't know whose plan it is, but one of the things they're going to do is to increase the window in which you have to resolve the loan issue to the next filing date. So if I did it now, I'd have till April 15 to get that loan back into another qualified plan, or I have to pay taxes on it.
Currently, it's like a 60-day
Yeah.
rollover. That this will be a deemed
You gotta
distribution.
get it into, so one of the things you don't wanna do,
Get it into an IRA. with 60
is do that like in December, so you shorten your window. If you're gonna do that, wait until January, because then you have 15 months to resolve it.
Mhm. Yep.
So you have to pay it back in a year.
Yeah, they force you, because the way they look at it right now is they look at it as when you leave that employer, you're making a distribution.
It's a deemed distribution. The
Or
amount
you've
of
made a
loan-
distribution because you've taken a loan against it, because think about it, you're not able to pay it back to your payroll anymore. So it's,
That only
ends up
happens,
being real messy.
that only happens if you leave the company. If you don't leave the company, how much time do you have to pay back that loan?
It's whatever term you take out, so if it's
So that's only
over
if
5
you leave the company,
years.
you're talking about the 60 days.
Yeah, and that depends on the plan too, it depends on what's the loan,
Was it
of the, when you look at the plan document, what does it say the loans can be up to?
And they might say, like, for example, a mortgage, if the loan is to buy a property, that loan might have a longer period to repay than another type of loan. And you're right, plan documents are, so There's general government rules, but they're customized.
All over the place.
Yeah.
Everyone is different.
Yep, you got to make sure you read it and understand it. So,
Oh, yeah.
all right, page 916, there's a great little rollover chart that basically, you connect the boxes and says rolling from to, how does it work? Okay, is it permitted? Has a bunch of, what is it, 7? Yeah, 7 footnotes down at the bottom. It says, it's basically you have a table that there's a ton of exceptions to the table, but, as far as on the next page, it talks about the reporting, the waiting periods, anything like that. It just, yep. So you can look at those and just kind of draw the little lines to match up.
To do with simple IRAs. Simples can only hold simple assets.
All right. Okay. But that's a great one because somebody will ask me and I pull out my quick finder or my tax book and go right to this, and always to make sure that, like I said, unless you're doing, investment accounts on a daily basis, you still want to go check all of them. All right. Okay. Page 918, there was, Patrick, there's that little paragraph you were asking about converting a traditional to a Roth. There's the rules that talk about there when you're doing that. Okay. In throughout here, all the reading, it keeps referring to the 1099-R. We're going to look at the codes when we have one of those. Okay. IRA beneficiaries, the rules for determining required minimum distributions from beneficiaries depend on the following. The beneficiary is the surviving spouse. The beneficiary is an individual other than the surviving spouse. The beneficiary is not an individual. Obviously, that it goes into the estate or trust. The IRA owner died before the required beginning date or died in or after the required beginning date. Okay? So, my 74-year-old father passes. I am the beneficiary. My 1099-R is coded 4. Do the RMDs apply?
Yeah.
I have to play by his rules.
Right, so if he was distributing,
Mhm.
you'd have to continue distributing or take distribution to pay out taxes.
Yep.
If he wasn't,
70 and a
because
half.
he was working,
Mhm.
and he hadn't started distributions yet, you don't have to start those distributions.
Yes.
Until when?
Until
So he
he gets to be, until his age,
Yes.
or
His age, 70 and a half.
My age, 70 and a half.
right, and if you decide to take it as a periodic payment rather than a one-time lump sum,
Mhm.
you can use his age or your age to take those distributions.
So if as I stand right now, whose age would I want to use?
Well, it depends on if you want money.
Okay. Fair.
If you don't
Fair.
want the money, then you use your age.
If a farmer passed away, then is the IRA owed? So we're talking about this right now. We dictate that the kids have to take it, the distribution at their later age or not?
No.
It's up to the
No.
kid to decide, right?
Whoever owns
So you're
it.
better off just leaving it into a trust.
Yeah, depending. You get some of that stuff when you look at annuities that are inside life insurance because the possible age of the beneficiaries, because they don't want them to waste it. So that, the beneficiaries could possibly be, 15 years old.
Right.
Chances are there's something that the beneficiary is going to be a trust.
There are rules within trusts that allow you, and it's tricky with IRAs, because they have some different rules, but if it's just a plain trust, there are rules in which you can delay payments out. But in New York State, you gotta be real careful if you have an attorney that takes it too far out, because they'll just void the whole thing. They can go fight and say it's stupid. You can't keep somebody who you've given money to in New York State for a long period of time, because New York State wants to collect their taxes on things.
All right, 1099-R is pictured on 919, and then a lot of them on the back of a 1099-R will have pages 920 and 921. What you can see there is on bottom of 920, there's the description for box 7. Okay? These are all the different codes that can be in there as far as what this distribution is. So, you know, these are basically what, if you think about it, all the little headers that we have on all the reading that we're doing. Okay? So you have all the different ones. You're going to see ones a lot because somebody took money out of their 401k for some reason. And then what's that form we go to if it's a 1, Mark, that we try to get them off the hook?
5329.
5329. Okay, you can see it right there that in box 7 it says certain distributions may be subject to an additional 10% tax. See the instructions for form 5329. Okay, like I said, we'll show you that one in the.
So what do you see to?
That would be for a,
Disabled?
no, code is a, code 2, for example. That was they, with regards to the Roth distributions.
Can be, you know, somebody that maybe, you know, separation from a company prior to 59 and a half. Mandatory retirement age in an industry or whatever, or something happened that would allow it to be.
Distributed without.
Yeah.
being a penalty.
Yep. So that where they're getting their money because of something.
So is there
downside
another
of it.
box when you get that shows you what the exception is, or do you have to go back?
You just go by the 2. Because the 2 will do the calculation for you on the tax wise.
I see.
You just have to understand.
So it's
Sometimes you'll want to
substantial.
ask and find out why they would 2.
Substantial equal payments.
Could be. Yeah. You see the death one I was talking about in 4. You see a lot of 7s, normal distribution, okay, because somebody's basically met all the things that they need to do, okay. We're starting to see a lot more Fs. That's where charitable, where they gave it to a charity, okay. The other one you see a lot of is Qs, all right. Now, you can see combinations. It doesn't mean there's just one letter in there. Sometimes you'll see like a 4Q or something, you know, where they have 2 categories that apply. So it's not just a single digit in the code. So sometimes you have to look at it because they'll put the 2 together, okay? Not often, but sometimes. All right. Social Security, okay? 922. Somewhere along the line, the railroads worked out a deal that their retirement and Social Security has handled different than the rest of us in the country, okay? So you're going to see, and I apologize that the book's not in live color. We did put in parentheses that there is the blue form and the green form, okay? We'll go through one of those. Most of them I want you to really focus on is just regular Social Security. Like I said, I showed you that one W-2, and I have one person I do every year that's railroad retirement. So
In the workbook, I couldn't figure out what form to use to put that in for the one problem. What line? Do you go to the Social Security line or do you go to
For-
the pension for the railroad?
we'll talk about it. We'll take a look at the problems, okay? All right, Social Security, SSA 1099, okay? This is Social Security and Social Security disability, okay? If it's SSI, is it taxable?
It could be.
It could be, it depends,
Depends on what your income.
okay? But most of the time we're gonna see this. This thing, again, I apologize, it's not in color. When it's somebody that's older, I ask them, do you have the one with the pink boxes? Because it's that box that's number 5 that says net benefits for 16. It's a pink box. Oh yeah, I got the pink box one. So, you know, rather than it saying, do you have your SSA 1099? They're gonna go, You know, or do you have your Social Security? And a lot of times they'll come in, they'll give me the letter they just got at the beginning of the year that says, here's your benefits for the upcoming year. You got a raise, which is $25 a month, I think, this year. So, you know, those are the, you know, what you get. But you want the one, oh yeah, the pink box one. And to me too, I've always thought, I guess it's not ironic, but some engineer got paid a lot of money to design that envelope that those statements come in, where you have to tear off and do this and tear here and then unfold here and stuff like that. All I can think of is they're giving this to all these people that are probably of arthritic age, because when these envelopes come in, they're just, you know, they, most of the time they won't even open them. So but I feel bad that that's the way they've designed the envelopes. So, but I'm sure that saves money somewhere along the line for the government. All right, So it talks about the bottom. It says, be aware of these boxes from the SS 1099A. Box 3 talks about the total Social Security benefits and any adjustments, including the Medicare Part B, Part C, Part D, F, G, H, I, J, K, L, M, N, O, P. Okay, so it'll have all those things on there. It'll also talk about any adjustments there. Now, do they get to net down the Social Security? Do we get to put on their return the gross amount paid? Or do we pay? So you get to take the Social Security, you get to take the Medicare out before you figure out if it's taxable?
Why there's an additional tax on Medicare over a certain amount.
Yeah.
And
But the amount is not, we do the gross before Medicare is subtracted, okay? Always pay attention to, it talks about here the box 6, all right? Okay. That is the tax withheld, all right? A lot of times that sneaks up on a lot of preparers because they're just, you know, most people have the mindset Social Security tax-free. It's not. Just as Mark talked about, there's thresholds depending on your age and your income and with your full retirement, and all this other stuff, because up to 85% of your Social Security can be taxable. And this is why it's great that this is in the same chapter as the IRAs, because I have people, and kind of what David was talking about earlier, I have people that come into me and their usual tax return is that none of their Social Security is taxable. All of a sudden they decide to take an extra distribution from their IRA as a payment. They're going to buy a convertible because they decide they're going to take a vacation, and they take that. Not only does it add to their taxable income, but also it might make some of their Social Security taxable. So it's like a double whammy because they traditionally have not had withholding out of their Social Security.
Would you say up to what percentage of Social Security?
Can be taxable, 85%. Okay. David was asking about we're now into the blue form, okay, with the railroad, all right. Okay, and we'll kind of see that in action. We may try to work through the problem there so that you can see it when it flows everywhere. Because, and like I said, you just don't see it. Well, I see a few in, like I say, I see one a year now. I used to see it 2 or 3 a year when I was out in Akron because there was a lot more railroad people out there, retired railroad people. So it's one of those that you don't see a lot, okay?
So we don't have to concentrate that much on the railroad?
Well, it doesn't. When you did the problem, do you kind of understand what happens with the railroad Social Security? It's kind of
I mean, I
split.
understood from the book what I needed to do, but I couldn't figure out tax-wise how to make the formula.
Yeah, because what happens with a railroad retirement, it's kind of split. It's like it's Social Security, but it's split into a retirement account and Social Security benefits. So it's not like it all falls under Social Security and all doesn't fall under
I
government
think I
pension.
figured out the tier 1 rate was the tier 2, but I couldn't figure out.
Yeah, and that's where, like I said, you see there when they show on that W-2 that I gave you, you see how they pay in separately, tier 1, tier 2. So, but yeah, it's almost as if the thing's been separated into a Social Security and a retirement account, like it's
Right.
separated between the two. Okay. All right. On 925, it says to find out whether any of the benefits may be taxable, compare the base amount for the filing status with the total of 1/2. If you really want to, I should have brought a copy of one, and I forgot to. On the back of the little pink box is a nice little simplified worksheet to determine. It's a very simplified worksheet. When you're trying to read this through here, it's very easy to do. There's the worksheet on page 926 that has it about taxable Social Security. I like to use the one that's on the back because obviously they created that for somebody to look at when they get their Social Security
And I
benefits.
thought I saw in tax-wise, though, it does the calculation.
Oh yeah, it does it for you.
Okay.
But sometimes somebody wants says, well, why is that the case?
Right.
And I'll take their little pink thing and turn it over and say, here we go.
Because I was
And I think
looking
it's
for
like
a
7
worksheet,
lines
it
or
was already in
something.
there. I learned to figure it out.
Yeah. Oh yeah, that's the nice part. But yeah, there's only like 7 lines on the one on the back of the 1099 or SSA 1099. Whereas this thing is, you know, it's the typical IRS thing where you do 3 lines and then you're going,
It's just bigger than that.
yeah. And then also you go, well, why did I just do that? Don't you love those things when you did about 3 lines calculations and it throws it all out because it doesn't really matter? Yeah. I always love that. When I was first learning and going through all these, I'm going, Well, that was a waste of my time. You know, I was into a spreadsheet trying to figure out a different formula because I'm like, I'm not going to, that's so. Let's see here. The taxable benefits, we'll talk about that on there when we get into the retirement. All right. Now, on page 928, we have our 1099R. See how, remember I was saying it kind of splits it into two? The blue one falls under 1099, kind of like an SSA. The other one falls under a 1099R. So it's like it's more of a traditional retirement account. Okay? So that's where the green one, all right? Benefits paid under the Railroad Retirement Act, which I would have to know when it was passed again. Somewhere along the line, they worked out a deal, okay? Fall into two categories. These categories are treated differently for income tax purposes. The first category is the amount of Tier 1 railroad retirement benefits that equals the Social Security benefit that a railroad employer beneficiary would have been entitled to receive under Social Security system, all right? So that's Tier 1, okay? On there, it also contains any Tier 2 benefit, talks about supplemental annuity benefit, all right? So that's where you see a little bit more of the 1099R. Is anybody confused yet when you read this? Yeah, so, yeah, it ranks right up there with when you're doing the ministers, because you got 5 worksheets going, and if you don't do them in the right order, then all of a sudden, X breaks loose, okay? But we'll kind of go through there when we do the problem. We'll go through them slowly, all right? So maybe we'll do that problem for our today, okay? All right. Okay, so that's pretty much it for Social Security. Okay, so let's take 5 minutes, and when you come back, when we come back, we'll do, let's see, which one was that, David, that you were talking about in there?
It is
Chapter 9.
It's 9-1.
9-2, Ralph and Bernice. Okay, so get in there, because they only have railroad? Nope, they got some other ones. Okay, good.
Yeah, well,
We got a little bit of both.
right.
So we can
and
kinda
they're-
get there.
And they're doing married filing separately. Because if you read the thing, they're divorced since 2006. They don't live together. So there's a few things going on.
Okay, we'll work through that one.
Yeah,
All right. It's got a lot going on. Okay, and we have Bernice, Donald.
So you would put the spouse in there even though they're filing separately?
Oop, I didn't read all the bullet points. Are they filing separate?
Yep, she's already filed.
Oh,
So she's going to go down under the married filing separate. Whoops. So married filing separate, her name will go down below.
Right. For Bernice, Donald, her social security number.
I have it right here.
Did you ever live in
All right, and did you live with your spouse? No. Don't have to worry about the second part. Okay, and we have the address. Okay. And Donald@gmail.com. We got some phone numbers here.
info sheet. Should we just do them separate?
Married filing separate. Mhm.
Yes, because they're married filing separately, so just like,
But when you go down, you do the separate, you put her information.
oh,
You'll see it as you go down.
Yeah, married filing separate, that's where her spouse's name will go in there. No
Now, what do
kiddos.
you do, like, if they don't have the social security number for the spouse? You gotta wait for it.
Mhm. Okay.
Amazing how many go to leave their husband when they retire and take care of
It doesn't say that in the bullet points. There's no editorials involved, Patrick.
It doesn't say that.
Okay. All right, back to the bullet points. Says Ralph filed a 1040 last year. He did not get a refund from his state. Okay. So if he filed a 1040, what did he do? He itemized, right?
No, it doesn't say that.
Yeah. Well, with married filing separate, what's in play though? Because if one itemizes, the other has to itemize. Okay. But he had no state refund, so we're not going to have to worry about that. Okay.
She took the standard deduction.
The person has to be 0.
She takes the standard, so he'll get the standard.
Right, so the answer is no.
But last year he could. We're talking about last year,
For 2016?
2015. Ralph filed a 1040 last year. So we're looking at the claim, but it did discount to say he did not get a state refund. So we don't have to worry about that. So chances are at the 1040, he may have had an opportunity to itemize last year. Maybe he had a year where he was sick, had high medical. So, but this year, yes, they're both taking the standard because she took the standard.
So the answer is yes there because of 2015.
Exactly.
Yes.
They were separated 2000. What's that? I'm sorry. What's that?
So help me walk me through that now. So you're saying yes because what led you to believe that he itemized last year
1040.
instead of the 1040?
A. For
Why else would he do that?
yeah, for the just for the sake of the problem, without seeing last year's return, if I see a 1040 for a retiree, chances are they itemized and he probably had high medical. Okay.
Okay, so the taxable refund is going red on mine now.
Yeah, but what's it say in the next sentence? He did not get a refund from his state. So do we have anything to put in there?
0?
Zero. So, okay. All right. They say Ralph and Bernice have been separated since 2006. They have not lived together since the separation, but their divorce is not final. Bernice has already filed her tax return. She takes the standard deduction. So if we go to page 2 of the 1040 at the top, there's a little question there. It says if you're line 39B says if you are married filing separately and your spouse itemizes deductions or you are a dual status alien, check here. Okay. So did they itemize? Did she itemize? No.
She took the standard deduction.
So we're just going to get rid of the red. The F3, get rid of that. Okay. Ralph retired from the railroad on June 4th, 2000.
So how do you get rid of, you click in it and then hit F3?
Yes. Ralph retired from the railroad on June 4th, 2012. He was 65 when he retired, receiving railroad retirement benefits. He received his benefits for the entire year of 2016. His annuity does not make provisions for a joint or survival annuity. Why do you think they put all that in there? Well, it makes it cleaner as far as the way that's coded and everything. So, okay. Ralph also has a part-time job. His W-2 is with his forms. Okay. So we got all of his main info sheet. We'll come back to our blue and green. So let's get everything else in there for him. Okay.
Page 2.
Yeah. Well, I'm going to go back and do his health insurance.
That's
He-
on 1.
The ACA.
Yeah.
Well, it's on the ACA worksheet,
Oh,
page 1. So I'm just going to clean up his health care here. Okay. All right. I'm going to page 126. We're going to get those in. All right. Because it said he had a little part-time job. I want to make sure I didn't miss his little W-2 working for Craft Tool and Die Company.
when you do the Affordable Care Act, it doesn't tell you anything there. It just says he had health insurance. So which one do you mark out?
The first two are no, and then yes after all 12 months. If he's of retirement age and he has Part A through Medicare, then he's met the minimum essential requirements under the Affordable Care Act.
The second section.
So that he had it. Okay. All right. And on his W-2 here,
Now we go to W-2.
Yep.
Okay.
we're going to put that guy in there for him. He worked for Craft Tool and Die Company. Okay. All right. Oops. Get the address in there. 425 Craft Road. He had some income here. All right. Nothing there. We'll clean up the 414H. And again, the New York employee state ID number,
16665, 5446.
as I was going to say, is the same as the federal one. Okay. All right. Now, why do we think that right now his little box came up, says, please verify the federal withholding, Social Security withholding, and Medicare withholding?
It's only saving 10%.
Yeah, just sometimes it's kind of popping up because it's saying that withholding doesn't look quite right. So we're going to have there. All right. Now, as far as the 1099-R on page 126, we can go back to our 1040. Okay. Once we're on the 1040, we have our lines 15 and 16 that talk about IRAs, taxable amount, pensions and annuities, taxable amount, check those roll over, F9, all this different stuff. Okay. Any one of those boxes, if we go in there and highlight it, what's it going to allow us to get? All right, so we can go in there, hit F9, we got our 1099-R, correct?
So which one did you go to?
Any one of the four.
Any one of the four?
Yep.
So,
I can get my 1099-R from this one, this one, this one, or that one.
yeah. Okay.
So it doesn't really matter that I get in the right spot because in a second I'm going to talk about what's on there, okay? Now, on the 1099-R, looks very similar to our W-2, all right? Make sure, and I emphasize, once you open the 1099-R, the first thing you do at the top is check who it is for. Okay, it's very, very important to make sure it's accurate because when I talk about here in a second the New York State considerations, that is of the utmost, especially if you have one that is not 59 and a half, or it's a year in which somebody turns 59 and a half, okay? Because then you have to make some adjustments. And the number that flows over to the New York State, it doesn't have all the calculations and adjustments, but we'll talk about that here in a second, okay? So we have that. We have the address matches up all right on there. Okay. We're going to put in our payer's code, very similar to what we would do with W-2. Don't worry about the code. This comes from Murphy Bank and Trust.
So that's the 36,331, 4,600.
What's what?
The payer's ID.
Payer's ID, I have 16,665,8854. We're on the bottom of 126. Okay. All right. We have that. One Murphy Center. Okay. A little small pension, little IRA, it looks like. So we have in our gross distribution 982. Okay. And in our taxable 982. This is where sometimes, remember we talked about the simplified and the general rule? Sometimes we'll have where this taxable amount is not in there, okay?
What do you get the 982?
We're on the bottom of page 126, the 1099-R, okay?
Oh, that's
Nope, we're not to the railroad yet. We're doing that 1099-R on that one,
That's a mistake I made.
okay? Taxable amount here is not determined, so sometimes it'll leave that tax 2 or taxable amount in box 2. Taxable amount not determined. We might have an X there on this one. We don't because the amount's in there. If we did, if you scroll way down at the bottom of your 1099-R, what's down there for you? Remember I said I'd come back and talk about that simplified rule, okay? So if you don't have a taxable amount, you can do the worksheet down there at the bottom for the simplified method, to put that in to get a determination. And a lot of times, like I said, when you use that simplified method, it may show that the taxable amount, or what would be in box 2, is less. Okay? All right.
This is from an IRA.
Yep, so we take a look. No tax withheld, nothing in box 4. And you can see how those boxes are in bold borders, so obviously important. Our code is 7, which we learned is a normal distribution. This is where we check the little box because it's an IRA. All right? And then again, like I said, down there in box 12, sometimes it hides. You get used to the fact that most things don't have state withholding. Some will, especially some pensions. Okay? So make sure you don't miss that. All right? Now, in this case, we have a little thing that we have to do some calculations here. And which one is that? See this little thing over here? This little box that says box 1, box 2, box 3? All right? That's for our New York State considerations. All right? Box 1, you check if the distribution is to somebody over 59.5 where those rules apply. Okay? Box 2 is, whoops. Box 2 is if it's a government. All right?
Government, in other words, he worked for him, he get paid for the government, or
The
1099-R, or?
1099-R, yes.
So where are you seeing that?
Listen,
How do you fix that?
Right here, and on the 1099-R,
No, I know, but how do you know which one to check?
because of box 1 is 59.5. Box 2 is somebody that is a government state pension that is exempt in New York. And then box 3 is for future use. Box 4 is what? Or I didn't say what box 4, railroad retirement. Okay?
And being a 1099-R, would that be railroad retirement?
No, this is just a 1099. We're not doing anything with railroads yet. This is just a 1099-R. Okay?
Box 2 again. Tell me.
Government pension. So if you were a state teacher's pension, because then it would say down here in the box on there, under state, it would say exempt. So that, okay? So we've done this one, and is Ralph, is he older than 59.5?
Yes.
Yes, okay?
That's the only box to check.
We're gonna check that box. All right, now, I want you to go to your New York 201, page 2. Okay, and we're going to go into that subtraction section. All right, we've talked about interest from bonds and stuff like that, but we can see pensions of New York State, local government, federal government, better known as box 2 on our 1099-R. If it was a box 2, it would show there that that was all tax exempt. The reason that we do that one is because any amount. State teachers' pensions, the lady the other day that works for ECMC, makes 6 figures. Her pension's equivalent to her salary as she stands right now, okay? And that is tax-free in New York because we were trying to figure out her tax liability. Taxable amount of Social Security carries over. When we do one with the 1099 SSA, anything that shows up as taxable on the federal will come over to the state tax-free.
So let me just go back to that one more time. So what's telling you this is when you're looking at the 1099-R, that you're looking at it 7 and then the IRA is checked. If it's another code that would say that it was a state pension, it would be different in there.
Yes.
If it was a railroad pension, it wouldn't even be in there, would it, or would it?
No, again, don't get the railroad in. I'm trying to get through the 1099-R. We'll come back to the railroad,
So
see all that stuff.
Where on the 1099-R would you know if it's a state pension?
Box 7.
Box 7?
No, not necessarily box 7. It would say New York State teacher's pension. And down for the state, it would say exempt. Or if it was a government pension coming from the military or, a state senator, something like that, a government pension, then you'd mark box 2. Okay? Now, just because they're participating in a government pension, but it's through MetLife, does that make it exempt as far as any amount? No. Okay? Now, yes,
I don't know, maybe I might have missed something. But on the 1099-R that I'm entering in,
Mhm.
my box 14 for state distribution automatically came up yellow. It says 982.
yes,
That's what it should do, right?
Yeah.
Okay, I was just wondering.
yep. So, and that's where, because then it reminds you in case there's withholding.
Okay.
But the state distribution, that's where you go to those other boxes on the 1099-R. All right.
Yeah, I never missed this.
Okay. So yeah, that, that would be down in there for the state. It could show up on there.
Put it in 12.
So,
You're getting this.
yeah, it's fine.
Yep.
I wasn't sure if I was still where you guys were.
Yep. So you'd have that with the 982. We check box 1. We go to our New York 201 page 2. And as I was saying, pensions of that state and federal government, if it's box 2 that's checked, and you know that as a state or government pension, then it's tax-free there. Okay. Taxable amount of Social Security is tax-free, subtracted out. Okay. Now, in New York, your pension and annuity income exclusion, it says here that you each get the first 20,000. Any person, the first 20,000 is exempt if you've reached 59 and a half. Okay. All right. Now, is Ralph 59 and a half?
Yeah.
Has he been 59 and a half the entire year? Yeah. Okay.
So you're in New York subtractions? Is that where you are?
Yes.
On New York 201, page 2?
Yep.
Okay, on line 29?
On 29, it says $982 for you
Yes.
because we checked box 1.
Correct.
All right.
Okay, so if I go back and check.
If I go back to the 1099-R and I said this was a government pension, that's where you got to make sure you get the right box on this because it doesn't calculate for you. Where does it show up now? On my government pension one. So if I check box 2, it goes on there.
Okay, on 29, it says any adjustments needed.
Just 1 second, okay? Just 1 second. All right. So we have box 1 checked, okay? And we're on the New York 201, page 2, okay? So we're in here and we got 982. Now it says if taxpayer reached 59 and a half during the year, okay, they're only exempt in those months where they were 59 and a half. So when I'm typing in that main info sheet or I'm looking at that, what's the first thing I'm going to look at? Yeah, especially if I see a 59 or a 60. Yeah, if their age determined the tax year is 59 or 60, I'm going, okay. And then I might have to look or I could look on the tree on the right if it's a previous client because there might be a 1099-R because I may have to exclude some of that tax exempt income. Because if you don't, 3 years from now, they'll get a letter from New York State. And like I said, that's why it's so important because what happens in this, and that's why I emphasize about checking either taxpayer or spouse, because they each get a $20,000 exclusion. So the first $20,000 of retirement income, like an IRA, is excluded. And you have to make sure that you get it between the two. Because that's sometimes where I'll talk to a client and they say, we're going to take out an extra $10,000. I'm like, okay, who's it coming from? Because if they take it from somebody that's already met 20,000, they're getting the triple whammy. They're going to get taxable income, taxable Social Security, and now that is taxable in New York if it's not a government pension. Where I could say, does your wife or spouse have an annuity that you could draw from? Still going to worry about taxable federal, taxable Social Security, but now maybe I can exclude it on the state because she has not met her $20,000. Okay? And again, this is something that's New York State consideration. That's why I wanted to emphasize it, is that it doesn't automatically calculate. Even if you've determined that they turn 59 and a half, what's on the main info, you still have to go manually look at that and calculate.
What do you manually put in? You have to go to a worksheet or what?
No. You'd have to determine what months with their, say that they turned 59 and a half in June.
That's it.
Yeah.
So you put in half.
Yeah.
because he's over 59.5, he means to put in the whole
amount.
amount of 982.
Yep, and it carries over because you check that box. Well, don't enter anything here, because that's the adjustment. So if I was gonna adjust half of it, okay? So I'm excluding $491, so he only gets to subtract half of the amount.
But in
Does
this
that make
case,
sense?
we're excluding the whole.
We're excluding the whole amount because he's over 59 and a half. If he turned 59 and a half in the year, in the tax year, I cannot exclude.
Okay, now.
You following that?
Yeah, because that's the 982, you're subtracting it from the adjusted gross income, you're not adding.
Yep, and like I said, for some reason, the letters this year with New York State, they put parameters on the letters that anybody, they question their age. And like I said, I had people that were 83 years old that they said didn't qualify for 59 and a half. I had to take pictures and scan in copies of their driver's license, plus the retirement account showing what it was coded, to send to New York so that they didn't have to pay a bill. All right? But like I said, this does not calculate automatically just because you saw in their main info that they were turning 59 and a half.
The interesting thing is with the function of 982 is a subtraction. The New York adjusted gross income stays up rather than coming down.
Well, you shouldn't put anything in there.
Oh, you should.
No, there's no adjustment.
No, you put 0, it should be 0. Better.
Yes.
Because he was
Already
60,
on there.
he was 60-some years old, so he was over 59 and a half the
I
entire
see.
year.
You only put it in there if you have to adjust it.
Because it's the year that he turned 59 and a half.
Yeah, so an adjustment would be if you turned, let's say July 1, right? You'd have 6 months or half of it.
You put it in
that you wouldn't be
Exactly.
able to deduct because,
And like I said, that's why it's so important too, to make sure when you get in that 1099-R in there, that you have the correct taxpayer or spouse.
Right.
Because then when you're getting there on this page here, you can make sure that they're getting their quota of the, because if you just automatically don't check anything, it'll default to the taxpayer. And then all of a sudden they maybe end up paying taxable income in New York when they weren't supposed to, because part of it should be under the exclusion for the spouse. So you have to make sure. So the first step is to make sure that you do taxpayer spouse up at the top. And the second one is to go to those boxes on there. Okay. And like I said, if it's a government pension where that's exempt in the state, then you would have that where it would show up on line 26.
So now when you go down to 34, it says Shakespeare if you're married, found separately, which he is. No, he's not married, so.
But he didn't itemize. Yeah. So
They're not married, period.
what's that?
Oh, no, they are, they're still married.
married with filing separately.
His spouse itemized.
Yeah. She didn't itemize. She took the standard. Because on that, remember we talked about, if she itemized, what's he have to do? He has to itemize, which means he goes to 0 and starts from scratch. Okay? All right. So 1099-R, everybody get all the important spots that were in there? Okay. We have, on the 1099-R, first thing is make sure taxpayer spouse, because now we see why when we start looking at those New York State considerations. Okay. When we get in there, if we have something that is not taxable or taxable amounts not determined, then down at the bottom, we have a simplified worksheet that we complete. Okay. Now, go back up and take a look in the exclusion worksheet. Okay. What's that first one that shows up there? This is on the 1099-R. So if it's not, oops. Let's see if I can get them both.
There's the rollover.
Okay, well, if it's not coded rollover, that's quite possibly where I can do the amount rolled over. Okay? All right? So that's where I have exclusion worksheet. So you can see some of the exclusions that we've talked about there. Okay? All right.
What's the learning curve on this stuff?
This is complicated.
This is where it gets in, it starts to get in because there's a lot of stuff that you have to do.
It says CF1 help on the state return. Use box 1, 2, and 3.
Yeah, if you hit F1, what's it tell you?
So that's what I need to review.
Well, if you hit F1 there, okay, for our 1099R, has distribution codes and stuff, has name code, all those things here, country codes, all that stuff like that.
If I go to the state return and I get F1, where do I see F1?
Has the exclusion worksheet, okay? So actually in here, there's really no, there's not really true help. You have to kind of know what those are. I realize that it says that on there that says, whoops,
On the state.
it says to go, you know, F1 for help on these. It's not, there's not really a good spot for it. It just kind of tells you instructions vary by state. So the tax-wise doesn't really have a direct route. That's why, you know, you have to make sure you understand box 1, 59.5. Box 2, government, or exempt on the state side. So, okay. All right. Okay. All right. Okay. So everybody's clear on the 1099R before we really start clouding it with the railroad. Okay. Everybody's good? Okay. All right. Let's take 5 minutes and let that soak in, and then we'll do the railroad. Because if I start doing that, you're going to go, well, wait a second, didn't we just? Okay. So now that we've soaked in all of the 1099R, and we've got our little boxes, box 1, box 2, box retirement, like I said, box 3 for future use. Mark was looking for the F1, please help me button. So, but just remember, 59.5, box 1. Box 2, government or tax exempt. That is for the purpose in New York for the way we just showed you that it flows over to our subtractions. And then when you're going through the client and you go to do that, double check that you know that they're but not beyond 59.5, or did they turn 59.5, so that you make sure that that's correct. Okay? It'll make us at the corporate office life much easier all summer long, because we won't be getting then letters stating that the income was excluded. And then, like I said, emphasize taxpayer spouse. Make sure you get that one correct. Okay? All right. Now, we're going to do Ralph's version of the his railroad retirement. Okay? Now, from the book, and if you look at these, how is each one handled? The blue one tends to be what? If you just even look at the categories. I'm trying to simplify this so we don't get too caught up in the blue versus the green.
Blue's a copy C and yellow's a copy B.
Okay, all right. Okay,
It looks like one includes contributions versus benefit.
okay. So what's that kind of telling you right from the gate? When you think about what we've talked about with retirement,
There's got to be some kind of basis. Or just-
One's a pension, he's an annuity.
okay, yeah, you kind of have that.
But they both say pension.
Okay. Look at box 3 on the blue one. I'm sorry, it's not color, but on the top one, what does it say? Social Security. Okay. What were you talking about that the blue, or excuse me, the green one said, David? Or it's David, Patrick? You said annuity, and it's form RRB 1099-R. Okay.
You have to find a different form to put all this in.
So remember what I said about the Social Security from the railroad? It's like they get this, but it's separated into Social Security and a pension.
The one's taxable, one's not.
Well, it depends. Okay. So we're going to see what this one does. So first thing we're going to do is the top one, the green, or excuse me, the blue thing. I wish they were color coordinated so I could, but the blue one, the top one, the RRB 1099, that has to do with their Social Security. So I want you to go to your 1040, page 1, and go down to line 20B, or excuse me, 20A. We got Social Security benefits. Okay, I got a couple boxes. We're going to light that guy up, hit F9, and in there, what do we have? There's a little worksheet for Social Security. Okay? Click on that and open that up. So at the top here, we have our Social Security. Okay? All right.
I did that and I can't find it now.
Well, look on your tree on the left and see if worksheet 1's there for you.
Because it's showing a number in here.
Yeah, there's worksheet 1.
Oh, Jesus. I just looked up page 2.
Okay, good. All right. So we have it. So this is our, where we would see our 1099 SSA that we were talking about, the pink box. All
So
right.
this is for the blue sheet.
Or the pink sheet. Or the
For
pink
Social
box.
Security, the pink box.
For
this
railroad,
one, the blue
yes.
sheet.
This is the blue sheet, okay? All right. See, we're trying to make it real easy for the retirees. We got pink, we got blue, we
We
got
need to make it
green.
easy for the preparers.
Well, we're trying to. We got pink and we got blue and we got green, okay?
We went to line 20, we did the F9, right?
Yep, so that we could get to our Social Security worksheet here,
Okay.
okay? Or other income. One thing we see there, you know, just kind of quick point out, see that additional earned income if we had scholarship or household employee, we've talked about that where there's no W-2, okay? Social Security and Railroad One, Tier 1 benefits, okay? Exactly, okay? So what is our,
14,121.
yep, so in there for our Railroad Tier 1 received this year, they received 14,121, correct? Okay? Was there any Medicare withheld?
Yeah, 1156.
1156.
You're good.
Oop.
In the wrong field.
My tab didn't work. Well, get back here. Okay. 1156.
Yep.
And what about tax withheld?
150.
150. Okay. Basically the same thing we'll do in our pink boxes. Remember that 1099 SSA that was on page, the one on page 9-23. Okay.
It's on 122.
Okay, or but on 923 in our book, that was the SSA 1099, okay? Because it said be aware of these boxes. So it talked about 3, 5, 6, okay? So we have that, all right?
Now, you don't need to do a spouse if she was also collecting this? If she was an employee or a railroad type person?
If the
Well,
spouse,
it's got a Social Security benefit railroad too, one of it.
oh yes, so it's married filing joint,
Yeah.
and there, and
If they
she,
both work for the railroad, she'd be in there too now.
exactly, or sometimes you see it where,
Social Security
yes.
and the railroad.
So we'd have the pink boxes.
They're both getting those. Or if the husband and wife are both getting Social Security, the form's just set up that way to be able to handle. All right.
Okay, all right, so we have that, okay? Again, we may talk, I want to get through this first. We'll come back to the lump sum election, okay? I just want to point out that at the bottom of the worksheet, there is a lump sum election. That's where that goes. So if you get one like the, well, which page did you say that was on, David? The 1099 SSA?
It's on page 122.
Okay, so 122 in the workbook, there's that form SSA 1099. See where it says box 3 has the description of amount in box 3, all right? What that is down a lot of times at the very bottom, it'll show years. It might show 2015 they got X amount, 2014 they got X amount, 2013, but it was all paid in 16. And again, we're not gonna, I probably shouldn't even brought it up, okay? All right, now, we have our blue section done, okay? Now, what do we do with our green section?
The green section in where?
The green section, you know, the green for the railroad pension, our tier 2.
Oh, now we're going to.
Okay. What form do we need?
Yes,
So you're gonna say 1099 RR or RB?
RRB 1099-R, okay?
Where do you get that?
What do you mean?
Where do you get that
Well,
form?
it's a 1099-R.
Oh, it's just a 1099R?
Mm-hmm.
So then you're gonna need a second one
Yep, so you're gonna need to create a new 1099-R.
Okay, so you can add it.
So this worksheet you're in right now, you get out of that and go back into the 1040 to create another 1099-R?
Yes, yep. So if you want to put no in your green section, because it's called an RRB 1099-R, 1099-R, correct? Okay? So we get into that. The way I make them is if I go to them on the tree, remember you can just copy it and then create a brand new one.
Yep.
But what's the first thing we always do once we open a 1099-R?
Check the tax bill.
Yeah, check who it's for. Like I said, just makes your life easier.
So you go back to page 1, you go down to Social Security benefits, right?
Nope. We're on a, that was the blue. We're doing the green. Okay? So you can go.
Oh, now I'm going green. So where do I go? 21? Other income.
You could just, we're gonna make another 1099, so go over here, 1099, just go over it and hit copy.
Oh,
Yep. That's a quicker navigation. Yep. Yep. So we got taxpayer, because obviously there's only one, he's doing separate. Okay? Now let's start to look at this. We're gonna go through his green section, his tier 2. Address is good. The payer ID is the 36. Okay, and it is the United States Railroad. Okay, and that is at 844 North Rush Street, Chicago. Fancy that, huh? All right. Okay. Now, let's start to look at this, and maybe you caught this when we were doing it. All right. Gross. What's it say in parentheses in box 1?
Well, it says RRB line 7. So you look at line 7 of the RRB.
On the green section.
It should be 955,725.
Yep. Okay.
So there's your footnote that you know how to do that. That's what I couldn't figure out.
Mm-hmm.
So you're putting it in line 1 on this, but it's referencing line.
Yep.
Line 7.
Yep.
Okay.
You know, and you can see down there if you want to put in there, there's employee contributions. Okay. Had some tax withheld.
What's the taxable amount? Because it's highlighting that as well.
Okay. Hold on a second. All right. Get through there on there. Okay.
So these boxes, I mean, do these boxes line up with the boxes on the 1099-R? Like, I mean, but it says 3, but if you go here, it says capital gain on line 2.
Which one? No, but if you look at box, no, it doesn't for the green section. What I wanted you to make sure that you noticed is gross.
I got growth.
Okay, got that?
Yeah.
All right. And we got our tax withheld, and you got your employee contributions.
Oh, yeah. Federal tax withheld, 250.
Mm-hmm.
Okay, and then employee contribution,
Mm-hmm.
That's going to be from line 3.
contribution, line 4, right? 14, 121.
It'll be line 3.
Line 3 and 397.
Oh,
And then the contributory amount, the 14,120, is that the, where are you putting that? In 6 or are you putting it in 2?
Don't worry about that on that one right now. Okay. All right. Now, let's see here. What's the best way I want you to follow along with this?
only comes in a lot of these. I'll send it.
Send it to me. Send it to me. I'll take it.
You want it?
All
I'll
right.
take it. Send it to me. I'll figure it out. We have to do a couple of them.
Yeah, that's all.
Okay. If you look at, it talks about because this one's kind of, I know it's kind of hidden, I guess would be a lack of a better term. Okay.
Yeah, but if you
What's
got
the
this-
code?
What's that?
What's the code?
Oh, you have to.
Are we still doing a code 7 because of the age?
Okay. Code 7. Okay.
But then you wouldn't put IRA simple.
No, we're looking at that.
No. No. Okay. All right. Because it says when in our textbook, it says,
Where are you reading there?
I'm in page 928, 929. This is the green form. Okay. Says FF RRB 1099-R green form, tier 2. Okay. Generally, amounts shown on form RRB 1099-R are considered a normal distribution. Distribution codes are not shown on this form, but the equivalent SSA 1099 distribution code would be 7. Okay. All right. Okay.
But we have to check that box too.
All right. So we have in there, it says box 7 is the sum of boxes 4, 5, and 6. Amount represents the total pension paid in 2016 included in there. Okay. Okay. Now, taxable amount. All right. We have to use our simplified method. All right. Okay. All right. So, if we go down the simplified method, what does it say?
There's where we put in like.
Okay. All right. It's like an Easter egg hunt, isn't it? Patrick,
Just put in the 10, 395 again, and he is, what's his age?
he is, what was he? I can't remember here.
Uh, 69.
69. Okay. So we're down there on his for 69.
69, 66 to 70.
And how many months did he get this? We're going to say all 12 months. He was obviously fully retired. Okay. So we've now figured out his taxable. Okay.
So you don't have to do anything for if the annuity started after 1986,
Mhm.
essentially not recovered tax-free in prior years.
Mhm.
You do?
No.
Oh, okay.
Nope.
So 9663 is what you get on the worksheet on the bottom?
Mhm.
Okay. And that's all we need to do on this particular sheet.
Mhm.
I hit tab, went to underpayment of estimated tax.
Yeah, that's because it takes you on the different form.
So how do
Do we still have to do box 1?
In the 1090 for railroad retirement?
Yeah.
Yes.
Yes.
Mhm.
Okay, so I'm getting closer.
So I checked box 1. And then we go to, what, New York, 201. And what's the-
I'm still not getting the same answer. I'm getting closer to it, but
How do I get back to the phone? I mean, I lost it now.
Go to your tree on the left and go to your 1099.
Oh,
Mhm.
yeah, I did, but that's the old one. That's the one I did before.
no, hold on. This one here is for this one. This one here is for. Didn't do it tonight.
This is not, we're not checking the box 2.
No, it's not a government
This is
pension.
not a government pension.
This is not- this is government.
So they got 134. What did you end up with?
179 and 544.
That's what I got.
Cool.
So federal refund 179, state refund 504.
Mhm.
Hang on one second.